to our companion podcast on important family business matters, Family Business Briefs, with our AI hosts, Jen and Ted. The content in these episodes comes directly from Family Enterprise USA and can be found at familyenterpriseusa.com. As we all know, many issues like taxes, economic policies, and new legislation affecting family businesses are complex. So, with the assistance of AI and our AI hosts, Jen and Ted, this technology helps make sense of it all in a brief, clear, and lively discussion, and all in about 10 minutes. We hope you find the information presented here useful and entertaining. Now, let's listen in on this episode's important family business topic.
Welcome to our deep dive today. We're looking into how policy really gets made in Washington, D.C., and specifically what that means for you, especially if you're involved with family-owned businesses, family offices, or, well, if you're a successful individual. We've got a really interesting article here by Pat Soldano, who's the president of Family Enterprise USA. It's titled, "Congress Listens When Message is Constant and Consistent."
Yeah.
And it really digs into the recent passage of H.R. 1, this one big, beautiful bill act, they called it. It shows how that kind of persistent advocacy really works.
Right. And what's fascinating, I think, from that piece is just how clearly it shows the power of being consistent.
Yeah.
You know, sticking to the message when you're talking to Congress.
Yeah, persistence.
Because it's, well, the article even says it's a chaotic place, D.C. legislation. But the message from Family Enterprise USA and, you know, their allies, it clearly, it cut through. They heard it.
Absolutely. So our mission today really is to unpack what this win means, look at the behind-the-scenes stuff that went into it, and then really get into the details of H.R. 1 that affect you directly. It's not just policy wonk stuff. It's about, you know, seeing how influence works and how that hits your bottom line or your business's bottom line.
Yeah, and if we kind of zoom out for a second, it really underscores how important that education piece is.
Yeah.
And the constant communication.
Right.
That's how stakeholders can actually shape, you know, critical tax and economic policies.
Yeah.
The article mentions a July 4th signing date for this bill.
A symbolic date.
Exactly. A really significant milestone for these groups.
Yeah.
A big achievement.
So, okay, let's connect that back. What does this actually mean for you, for your finances, or maybe for businesses like yours? The article lays out a pretty clear list of what H.R. 1 achieved. Let's dive into those specifics.
Yeah, and the article makes a point of saying, you know, a lot of this happened quietly behind the scenes, working on Capitol Hill, talking with House tax teams, individual members. It wasn't just like big rallies. It was educating them on these, you know, complex tax and economic points, which is often how it gets done, right? That sustained, detailed effort.
It seems so. A great example of how that can lead to, well, real results. Tangible stuff.
So that brings us to the obvious question. What were the specific wins?
Yeah.
What came out of all that advocacy? The source gives us a pretty good checklist.
Okay, let's break it down. The checklist of wins for family businesses, starting with the TCJA extensions, Tax Cuts and Jobs Act.
Yes, the 2017 law.
Right. So H.R. 1 makes some of those expiring parts permanent, or at least extends them. And crucially, it locks in those individual income tax rates. Also really important. The bill does not add a new tax bracket for high-income earners.
That was a big point of contention, so locking that in is significant. Then it gets into estate and gift taxes.
Always a major topic for family enterprises.
Absolutely. So the bill permanently bumps up the estate and gift tax exemption. It goes to $15 million, up from $14 million, starting after December 34, 2025.
Yeah, it's indexed to inflation,
Yeah.
right.
That's right, indexed to inflation, so it should keep pace. But maybe even more impactful for some is that it specifically avoids getting rid of valuation discounts for estate tax.
Explain that a bit. Valuation discounts.
Sure. So this lets families discount the value of, say, a non-controlling interest in a private business when calculating estate taxes. It reflects the lack of control and marketability. Keeping those discounts can, you know, significantly lower the potential tax hit.
Got it. Okay, that permanent higher exemption plus keeping the valuation discounts. Yeah, I can see how that's huge for long-term planning.
Monumental, really.
So that's individual and state stuff. What about the businesses themselves, especially pass-through entities?
Good question. It tackles that, too. It makes the Section 199A deduction permanent. That's the 20% deduction for qualified business income.
Right, for partnerships, S-Corp.
Exactly. For LLCs, too. It helps, you know, kind of level the playing field between them and the C-Corp with their lower corporate rate. Making that permanent provides a lot of certainty.
Okay, certainty is key there. What about capital gains? Any movement on that front?
Nope. The article is clear. No changes, no increases to the top capital gains tax rate in H.R. 1. So status quo maintained there, which is generally seen as a win by investors.
All right. Now, this next area, R&D and investment. This sounds like where things get really interesting for businesses wanting to grow.
Oh, absolutely. This was clearly a major focus. The bill brings back full R&D expensing, meaning businesses can deduct 100% of certain research and development costs immediately in year one, instead of spreading it out over years.
Okay. That encourages R&D spending right now.
Precisely. And related to that, it also permanently restores 100% bonus depreciation effective January 20, 2025.
Bonus depreciation. Remind us.
It lets businesses immediately deduct the full cost of purchasing new eligible assets like machinery or equipment, rather than depreciating it over time. Again, it's about incentivizing investment now.
Gotcha. So immediate deductions for R&D and for buying new stuff. Big incentives.
Very big.
What about property? Real estate folks always watch this stuff closely. Like kind exchanges.
Still there. The bill keeps like-kind exchanges, or 1031 exchanges, exactly as they are. No modifications.
So you can still defer capital gains when swapping investment properties.
That's right. A huge relief for the real estate sector and other businesses using similar assets.
Okay. What about some of those broader tax ideas we hear debated? Wealth tax, surtax.
Successfully avoided, according to the article.
Yeah.
From the perspective of the advocates here, preventing a new wealth tax or a surtax on income within this bill was a major defensive victory.
All right. Now, the alternative minimum tax, the AMT, you mentioned a nuance here.
Yeah, this one's a bit tricky. So the AMT, it's like a parallel tax system, right, to make sure higher earners pay some minimum tax. H.R. 1 makes the increased AMT exemption from TCJA permanent, which is good, but it resets the phase-out thresholds for that exemption back to 2018 levels.
Meaning more people might hit the phase-out sooner.
Exactly. The article suggests this could actually pull more individuals back into paying the AMT. And importantly, if you're subject to AMT, you generally can't claim the SALT deduction, the state and local tax deduction.
Ooh, okay. So that's a really key detail for people in high-tax states, potentially. Definitely something for you to be aware of.
Absolutely. A definite flag there.
What else did they manage to protect or avoid in this bill?
Two big ones for estate planning: grantor trusts and step-up in basis.
Okay.
The bill avoided making any changes to grantor trusts, which are, common planning tools. And crucially, it avoided eliminating the step-up in basis.
Remind us why step-up is so important.
Well, when you inherit an asset, say stock or real estate, its cost basis gets stepped up to its fair market value at the time of the owner's death.
So if the heir sells it right away, there's little or no capital gain.
Exactly.
Yeah.
It wipes out the capital gains tax on the appreciation that happened during the original owner's lifetime. Eliminating it would have been a massive change for wealth transfer. Keeping it is a huge win for inheritors.
Massive is right. Okay, one last item on the checklist. Business interest deductibility.
Right. The bill restores the EBITDA-based limit on deducting net business interest expense. That's effective December 34, 2024.
EBITDA. Earnings before interest, taxes, depreciation, amortization. Is that generally better for businesses?
Generally, yes. It's usually a less restrictive calculation than the EBIT limit that was in place more recently, meaning businesses can potentially deduct more of their interest costs. So, seen as favorable.
Okay, wow. That is quite a list of wins and preserved provisions. So, stepping back, what's the big picture takeaway for you listening?
Well, I think this whole deep dive really hammers home how vital it is, right? For specific groups, like family businesses here, to have that constant, consistent voice talking to lawmakers.
Yeah, the passage of H.R. 1, with all these details we just walked through, it really feels like proof of that strategy, that behind-the-scenes, persistent work the article described.
It really does.
Yeah.
But it also raises that question looking forward. I mean, policy's always shifting, isn't it? So how do individuals, how do businesses like yours keep ensuring that message gets through? Especially when, the article itself basically says, hey, you got to keep watch because things can get reversed.
That vigilance point. It's not like, okay, we won, game over.
Not at all.
Yeah, that quote at the end of the article really sticks with me. If they don't hear from us constantly and consistently, our messages will never get through.
It's powerful, isn't it?
It really is. A reminder that, yeah, you can achieve these big wins, but the actual work of staying plugged in, staying engaged, it never really stops.
So maybe a final thought for you to consider. What really stands out to you from this whole example, this story of advocacy? And maybe how could that idea, that consistent engagement, that targeted communication, How might that apply in other areas where you want your voice, or perhaps your community's voice, to actually be heard and, well, make a difference?